Hi, good evening, everyone. This is Muhammad Ali. First of all, please accept my apologies due to the technical reasons. My voice is unable to reach you all. I hope that you guys are listening me now. Excellent. Now, anyhow, I have taken a longer period due to this one. So, before I start, let me introduce myself and my company. Myself, Muhammad Ali, and my company called NCL Investment, regulated and licensed by CMA. Well, this time our company come up with again a new subject called how to become a professional trader. This is an opportunity is going to provide to all the investors, those who are interested, especially the capital investors, those who are interested to trade in currencies, commodities, securities. Excellent. So before I start how to become a professional trader, we need to know that the major thing that to select the broker. Okay, this selection of a regulated broker is very much important. By checking that it's truly licensed, regulated, and authorized, where you reside. Regulated and authorized, it means that it is an addition to a broker's regulatory status. We need to know that which regulatory body it belongs to, as we do not all follow the same type of regulations or offer the same type of financial protection. Well, it is a major thing and the primary subject to find out which broker is a regulated broker. Of course, this is because we need to safeguard our investment, where we can make assure ourselves and the transparency of our fund that the regulated broker is following and belongs to which region. Here we come to know about the regulated brokers, the way of working, and security of our investment. Now, let me move forward to the next slide. To become a professional trader, you must learn trading basics and advanced basics. Actually, these are mastered. You can learn trading strategies and gain experience in implementing them in your daily trades. Okay, getting me? Well, one of the most efficient methods of learning to trade is market and the trade basics. Well, we are going to understand the basics of the foundation that will support your entire career. The first level of knowledge is required before more advanced training information can be successfully implemented. Well, I have a few steps, a few important points where we are going to learn about how the professional traders are going to adopt and what they are going to adopt. Main point. First of all, let me start with what markets to trade. And we are the traders who have to understand before start something that what are the markets to trade. Okay, like currencies, commodities, in which markets we are interested. Okay, and they are connected to which exchange. One thing. Second thing, we need to understand how the price moves, which is called as a bid and ask. Okay, so these are the two options have been given when you are going to start a trade, which is called as bid and ask. These are the two prices where you can ask, and when you would like to go for a bid, then which price is going to acquire on a bid side. Now, the third option is like order types. What are those orders you can adopt while placing them, and how to place them, in which circumstances you can use those orders, as we see always that there will be a kind of market fluctuation, sometimes a heavy market fluctuation. And basically these orders are very important when we work on them. during the daytime or long-term trades also. Fine. Now let me move to risk management. Risk management is something where we are going to predetermining our risk, that how much we can do or we are accepting the loss. Fine. So I'll be going to be in detail in the coming slides. And we'll talk about fourth one, which is trading hours. So how many hours we are going to trade before we start something? So there should be a planning. Planning is very much important when we start any sort of trade. So how many hours we are going to start trade? So it is a short term or long term. So the predetermination is very much important before we start any trade. And how to monitor trading performance, that once you made a trade and the trade has been executed. After execution, how about your destination or how about your target price? Then the last, you can see that how much capital is required to trade efficiently. So before investment, you must have to determine your capital investment, that how much amount you're going to start at the initial stage to have a practice at the initial stage. Fine. Now, slowly and steadily, we are going to learn about the first step of trading, that what a professional trader adopts. So our next slide shows us very much clearly, which is the basic and the primary from my side, which I give more recommendations on this one, which is fundamental analysis. Now, what is fundamental analysis? This analysis is a way of looking at the forex market by analyzing economic and social data and political forces that is, and those forces are going to affect the supply and demand at an asset. So let's suppose you have understand the reasons of why and how certain events like an increase in unemployment rate affect the country's economy and monetary policy, which ultimately affects the level of demand for its currency. Let me give an idea. When there is an unemployment rate affects the country's economy, then we are going to see that country's interest rate is going to decrease. So this is going to affect the currency for that particular country, for the particular region. The idea behind this type of analysis is that if the country's current or future economic outlook is good, then their currency should get better. Okay. And the better shape of the country's economy is more foreign business, more investors will attract, and if they are interest in that country. So this results in the need to purchase the country's currency to exchange those assets. So here in our trading, the fundamental analysis is also going to play a crucial and major role. So whenever we are going to get these sort of users, we have to keep on updating ourselves with different and several websites who are going to give us economic calendar views. Now, let me go for a brief discussion on that one. Hope you guys are watching this picture. These are the two images of good economy and bad economy. The higher currency value is called as a good economy, and the lower currency value states bad economy. For example, let's say that the US dollar has been gaining strength because of the US economy is growing day by day. As the economy gets better, raising interest rate may be needed to control the growth of inflation. It means that when the economy is getting strengthening, let's suppose, at that time, the concerned authorities, they take measures to control the growth and inflation. So higher interest rate makes the dollar dominated to denomination and financial assets more attractive. In order to get their hands on those lovely assets, traders and the investors have to buy some more greenbacks. As a result, the value of the dollar will likely increase. So it means that, as we are going to show you the example, here it shows that the higher interest rate makes the dollar denominated. And there will be a denomination of the dollar, where we see the financial assets are more attractive. Hope you are getting me, and just try to ask questions in between if you require, and I'm just following on this one queries. So I will be going to reply before the session ends, and I'll be providing you the proper time to think and give me more feedback over the same session. Now let me move to forward. The strategy is what we have to adopt while trading. Now, how many types of strategies that we are working at the moment? And being a professional trader, what strategies you should adopt? Fine. Here I'm going to show you that there are almost 5 core strategies which are going to work out. But majorly there are 3 to 4 which I personally recommend over them. The first is position trading. Fine. Second is swing. Third, you say it as a day trading, which is called as another form as intraday trading, scalping, and transition trading. So these are the few strategies where the professional traders adopt in their daily life. So, do you feel lost trying to figure out which forex trading strategy to use? Well, actually, I'm going to explain you in a brief conversation. Well, should you be a day trader or swing trader or position trader? Now, it's really confusing for you to understand that which trading strategy I should adopt. And because it's a combination of different forex trading strategies, it can be frustrating, I understand. Because you have seen traders make money with different forex trading strategies, but when you attempt it, it fails you. Anyhow, nothing to worry, because it's today's post will show you more 5 types of trading strategies that work on how to find out the best one that suits you. No worries, let's begin the session again in a brief manner that our first way of trading, or I should say position trade, the way of trading is a position trading. Well, position trading is holding another form of long-term trading approach, where you can hold your trades weekly base or sometimes month base. The lifetime of the trades can be depend on the market especially market movement, as well as until or unless it reaches your target or its destination. The time frames you will trade on usually the daily or weekly. As a position trader, you mainly rely on fundamental analysis in your trades. Let's suppose I have just a few minutes before I have explained you about the fundamentals information or the news which you can avail from economic calendar, any of the leading websites which give you the financial information. Also, you might use the technical analysis to better time your trade. Let's say you analyze for the fundamentals of Euro USD to determine its bullish or bearish, but you don't know that which way to go. Shall I go for a long at a price, or shall I go for a short? So you wait for your Euro USD to come to support before taking a position. Now, in your analysis report, you could enter at the start of a new trend before anyone else. Let's suppose I'll show you this figure it out, the first one, where to enter. This figure is showing us here, when you see a chart of Euro USD, here clearly it shows that how the candles are, just figure it out, the blue candles, the green, sorry, the green candles, where it shows that slowly it moves and at the upper direction, and it closes again and again every hour, every 4 hours, and daily basis it closes in the upper direction. So once it moves, if it is going to cross the first fall of the candle, then here the trader mentions that it will be a buy level. So if you are going to enter at this level, I am making a target for the next fall of, because this is the resistance which is going to make here for the Euro-USD. And the moment when it's going to cross its first support, you feel to clear your position, and I believe that you must exit here where the trader has given an example in this below diagram. So the area of support here given, like the entry point where we are going to catch the move actually, and the exit point where we must take out the benefit from this trade. I know, I understand at the moment, the technical is slightly complicated, but majorly I advise most of them that concentrating on technical, because these are the reports which we are getting now at this in front of your screen, which is past. So we must have to think one step forward and try to be more compromising. So if the market doesn't reaches to your target, just compromise yourself and close the deal or exit the position. So at the moment which I have given you the explanation on the position trading, is a simple way that in this trade you are going to hold the position for a longer period. It might be days to weeks and sometimes to months. But at this point of view, you must think that you have a sufficient equity to hold a particular position. And I hope that you are getting me now. When you have a limited amount of investment, then I don't advise and I don't recommend to go for a long-term trading or position trading. In a simple manner, position trading for those investors who are not really connected to the system in their daily life. Well, I hope that most of us are getting me, and any point of view you found any query, just feel free to type the question and I'll get back to you the next one. So let me move to the next slide. So here I'm going to discuss about the pros and cons of position trading, which is long-term trading. See, here you don't need to spend much time, as I have discussed just now, on your trades for a longer term, of course, because it is not going to give you any sort of stress. It is, of course, the less stress in your trading, as you are not concerned with the short-term price fluctuation, and your target would be, of course, your target will be higher level, and the favorable risk reward on your trade possibly 1:5 and more. The cons are like require a firm understanding of fundamentals driving the market, as just before I have explained that fundamental uses which are going to play a crucial role in each and every trade every day in the trading markets. And for this one, of course, we require a larger capital, which I discussed that it requires a serious amount and disciplined investor. You may not make a profit every year, of course, but during these trades, these positional trades especially, the chances of getting profits are more than 60 to 70% if you compare with the short-term trades. Then the last trading strategy called trend following, which is similar to the position trading. The only difference between the trend following is purely technical approach that doesn't use any fundamentals. Because when we are going for trend trading, and which is purely depend on the technical analysis, because whatever happened past with those, the candles, what they are going to show us that what was happened which candle is going to open at what level and which is going to close, and what sort of support has been made last month to last week, what would be the closing pattern last week's trade. So this is called an technical analysis. So it doesn't give any importance to the fundamental news. Anyhow, now let's discuss. Let's go to the next slide, which is called as swing trading. Now, swing trading has another form of medium-term trading strategy, where you can hold trades for days and even weeks sometimes. Right? So this type of time trades in time frames which you are going to start with, like it happens in 1 hour to 4 hour difference. So basically, these trades, these swing trades are known as a day trade or intraday trade. So as a swing trader, you concern to capture the single move within a 1 hour candle to maximum 4 hour candle in the market. Let's suppose you are going for any sort of currency or any sort of product. Just go for a buy support. Whenever you go for a buy, you're going to see buy support. Then you make it as a wherever you found, this is called a buy support. And when you see the next resistance, which is not going to break out, here it would be called as a sell resistance. Yeah, this is the buy support, and this would be the sell resistance. So here you can clear out everything. And again, whenever you found, make a short position, then you can go for a buy close. So these are the trade breakouts. And again, if the market gives you a chance, this is called as a trade pullback. Again, the trade. It means that in a single day, you will be getting an opportunity to go for a multiple trades. Yeah. So here in the second picture of our analysis, technical analysis here, Euro USD. I'm sorry, just apologies. It's a dollar Japanese yen. Again, here this picture is going to show us that which part we are going to take a short entry and taking the profit. So this is called the sell resistance with the buy support. And this support, this is called the area which is going to support where it is not allowing market to fall further and still taking pullback. So these are called the pullbacks. In the next picture, which you are going to see image. I hope you are listening carefully, and let me come back to you with the new slide. Now here, the pros and cons for this swing trading. I got you. So at the beginning, I have explained that swing trading is a short-term trading where you have an opportunity that in a day you can go for a multiple trades. Fine. So you don't have to quit your full-time job to be a swing trader. Of course, it's possible to be profitable every year because you have more trading opportunities. It means that in a day you are going to trade multiple trades, and majority of the trades, of course, is going to give you experience as well as with the profits. So here it gives you more opportunity. Let's suppose if 2 to 3 trades have been in a negative area, then the fourth onwards, personally you will feel that which area you should gonna enter, what would be the support the market is making, and what resistance you can see to close your particular trade. So this is going to help you out in a daily multiple trades, and in between you found any drastic fall or drastic market moves against you, of course you are going to close down the position. During this session, during this sort of hectic movement or hectic fluctuation, you are not going to bear any huge losses. So this is the very best advantage, I should say, in the short-term trading or the swing trading. But in the con area, I should say that won't be able to get big profits. You are not going to be big profits like as per 1:400 times. I mean, as per your invested margin. Okay. and that is not going to be happening in overnight risk area. So now, if you want to learn more about swing trading, then there are few websites which going to be available where you can work out, and you can use this in your information. Now, let's move to the next slide. Day trading. Now, day trading is a very short-term trading strategy where you will hold more trades for minutes or sometimes maximum to maximum hours. Because in this day trading, you are taking a very less amount of time, but quantity would be higher during as per your normal trading structure or your standards. Okay, so the time frame you will trade not more than in between 5 to 15 minutes or sometimes maybe half an hour, like 30 minutes maximum as a day trader. So your concern is to capture, and your concern is to catch the fast move which is going to be in your favor during this volatility of the day. So this means that you must trade the most volatile session of your instrument of the particular product, because the money is made so you likely for the particular day. Before you start in a short-term trade, what is the perfect move is going to be happening in the coming moment, in the coming few minutes after, and what will be the result, and is it negative or positive? The moment the result appears, you can start your trading. And a fraction of minutes and fraction of seconds, the moment when you see the profit in your trade, then you are the one who is going to close. So this sort of trading is known as a day trading or very short term. So here also you are going to see that buy support with the resistance. Of course, trade breakouts will be there, and for the multiple trades, you need to identify the trade pullbacks. Wherever the trade is going to bounce back with the moving average, which all is going to cover under technical analysis. Now, you will identify your bias for the day, whether to be a long or short, and to take the direction for the session. An example I will give you, the below chart. Now I am going to show you the chart for the USD CAD. Now this is the chart which we are talking about. Just have a look here, USD. Now this is the area called resistance. Here, Canadian dollar against American dollar has tried to raise up to consent level, okay, and again it fell down. Then the second time it tried to approach and try to break this resistance, but it couldn't. Again, third time it tried to test this area. Again, this has become a strong resistance because this will be the first, second, and the third area. Then again it came down. So it means that the 3 times it tried to break out this resistance, but it couldn't. So it means that this area has become a selling level or best level to make a short sell hold. Fine. The later on you can find out that because after achieving 3 times or approaching more than 3 to 4 times, then their market didn't find, I mean this product didn't find proper resistance area to break out and move further higher. So here this area especially you can find out to make a short sell, and from here minimum 40 to 60% of area you can cover your profits. This is the potential exit area, where in this one it is mentioned as a potential exit. The next image shows us that this is the potential exit area, because when we have entered at the third bearish engulfing area, which is called as the best resistance point. Fine. So here if we have made a short sell, then of course we are going to take an exit at the between 40 to 60% of the fall. So this appears only with a short-term trade, of course, or which is called as a day trading, because we have to get ready for the next trade again. So in this one, you will find, like, if you are a good, you can make money on the most of the months, because every day you are making few multiple trades, and weekly it goes to the very good numbers again of the trade. So if you calculate in an average, you will come up with minimum 60 to 70% of your success rate. Well, in no overnight risk, because anyhow you are going to close all your positions at the night, so there will be no rollover position for the next day. So it's again risk rewarding ratio that all the positions have been ended for the day. In this one, you will find a slight stress, of course, because it will be constantly you are trading and watching the markets, no doubt, because you must be careful when your trades are on, and possibility that losing of a lot of money in comparing to the other strategy which we have spoken or which we have spoke about, or similar if you just compare with the long-term trading, or if you just take out with the sweep trading, right? Now here there is the opportunity cost you could be earning a full-time salary elsewhere. Like here you can make this sort of strategy as your full-time salary, and it would become a primary working area for you. So when you invest, when you start any capital investment, so before you start anything, you must have to look into your strategy, that which strategy you are going to adopt. Fine. Now let me move to the next slide. It is called as a scalping. Scalping is nothing but, I'll tell you something. It is very short-term trade. Well, that depends on that every moment you are ready with the next to next second what happens and what next candle when it's going to be open, because it's purely depend on the technical trades. So I don't recommend especially scalping, because this sort of trades has been done by the retail traders, and I don't categorize them in investors, of course, because these sort of transactions cost to eat up most of your profits, of course, because multiple profits you are taking, and once you are ended up with the paying by commission to the broker. Anyhow, if you still want to learn more and about the scalping in a very short-term strategy, we will, of course, we will hold up trades, minutes, or even sometimes seconds. Anyhow, as a scalper, you are concerned with what the market is doing now and how you can take advantage of it. See, in this one, the main tool you will use to trade is order flow, and keeping which order. And at the beginning, I have given you an option like information like what sort of orders. So here, in the scalping, you can put advanced orders, which is called as a buy limit or sell limit. Yeah, of course. So these orders are also known as a contingent order. Inshallah, next session when we start about the orders, I will be going to give you a brief explanation of the orders. Well, the pros and cons for this strategy have lots of trading opportunities each day, each hour. Okay, I should say that every hour, and can make a healthy income, of course, but in a short period. Then consequently, you see that the cons of this strategy has high financial cost. Of course, paying years for software and getting information, collection of information from different and several websites, new agencies. So it's going to be, this could be a financial cost. And you have to be, of course, every time, every moment in front of your screen for sometimes hours, 2 hours, and sometimes a day also. So this is, of course, this will end with you a high stressful day for this sort of trades. Now, let me clear one more important thing, that fine. If you want to be a scalper, of course, I recommend you to join proprietary trading firm, because what is proprietary trading firm? Actually, this is a financial instrument trading firms. So this sort of company or this sort of firm will specially make themselves as a trading area or a kind of the portfolio maintenance for the investors, for the big investors. So they have such kind of ability and capacities, of course, to do scalping with a high and large amount of quantity in their trades. So this cannot be, and of course I don't advise and I don't recommend for an individual investor to work out on a scalping strategy. Fine. So let's move to the next slide. The transition trading. Actually, this sort of trading has not been done regularly. So you have probably never heard about this one again because it came up with it. Anyhow, it's here how like while I was in a proprietary trading, one of the interesting things I learned was transition trading. Probably wondering because actually this transition trading, well, the idea is you want to enter a trade at a lower time frame, and if the market moves in your favor, you can increase your target profit. It means that it is known as a trading. What we can see in the second image, it shows as a here your entry. You have moved your trading, your target. Then again, if the market moves, before market reaches to your target, you have increased your, you have changed your target to section A to B. So it means that it's a trailing level. The moment your target is about to reach, you are in front of the screen, of course, to change the target level. So this is a sort of example where it is called as a transition. Of course, it's a new one and it's not regularly used or in the practice in the daily trade. Now, well, I have seen traders wasting many years on the trading strategies, and you understand that doesn't suit them right from the start, of course. Only if they consider these three things I'm about to share with you, actually, they could have saved years of frustration, money, time, and effort, of course, because I don't want you to be one of them. So before you attempt any of the trade or forex strategy, you must consider these three questions, because when we have in our mind at the moment that which anyhow I have given you a few trading strategies. So which are those strategies you would like to adopt? So the next slide is going to give you the picture, the clarification that which trading strategy is going to adopt. Now, after adopting the strategy, you have a very important subject on this one, that how to manage your risk. Because anyhow, when we start any sort of trade, like it might be a long term, it might be a short term, but there should be a sort of risk that you are going to predetermine your risk before the trade ends. So I hope that everyone is getting me. So here the next chapter or the next section which comes for this risk management. In each and every investment area, we have a risk management, especially it is derived in this capital investment approach. So it's like the foundation of a house. When you build a house, for the first start with the foundation layers, and only when you start building the walls and the roof and etc., you keep on continuing. So on that note, risk management is the foundation of that particular successful trading plan. So when basically break risk management foundation into three layers. Let's suppose I'll give you the three important layers. The first is risk planning. So you have to plan a risk, that how much risk you are going to take in this particular trade and into the particular area. Then trading risk reward ratio. That is, after taking the risk, what would be your rewards, and how much percentage of reward you are going to get when you put a risk. Then position sizing, and what position and what size you are going to put on a position particularly. Let's move forward. We are going to see how one can use these parameters, risk parameters, to generate the superior risk rewards ratios for our trades. Now, how to plan risk? Planning risk will help you to maintain consistency when the risk we take trading the market. Becoming a consistent trading is one of the biggest hurdles that you need to conquer, and it can only be done right from the day one if you have planned for your risk exposure. So when it comes down to planning your risk, we need to be able to understand, and we need to be able to answer each and every simple question. So how much you are willing to risk per trade? You get me now? So before you starting any sort of trade, you have to ask ourselves. I mean, I must ask myself that how much risk I'm planning or I'm willing to take on this trade. Well, ultimately the answer is that to this question is personal preference. It comes down to your risk tolerance. However, professional money managers recommend not risking more than 2%. But what I personally allow at this competitive market, especially in a way where the trend keeps on changing more than 4 to 5 times. So we can also increase this risk ratio more than 2% to maximum 5%. So the main advantage of making risk higher 2 to 5 rule is that you will be able to make more trades in a particular time, which we have discussed a few minutes before in a short-term trading or a swing trading, because we get multiple opportunities in that particular hours, during that particular hours and the main whole day. So conversely, make the more risk per day, the more risk per trade you take, intuitively you will be prone to make few more trades. So the risk per trade is something that you will probably begin with to define over time, but don't try to ramp it up too fast until you have got some good trading experience behind. It means like you have to be a more experienced, more good enough, to understand and to begin, to define these sort of trades. So in a simple reply, I should say that whatever the risk ratio you are going to plan, so risk rewarding ratio should be higher than the risk taking ratio. Okay, so in the coming example, I'll show you that how to take or how to plan your risk. Now you're going to here determine the risk dollar amount. Fine. See, the risk dollar amount is equal to account size multiplied by percentage of trade. Let's take an example of 5,000 is your investment. Okay. Now you're going to start with $5,000 of your investment with a risk tolerance, which is called risk planning. Okay, 2%. Your dollar risk amount is 100 per trade. Fine. It means that whatever the trade you are going to get start now, so you are putting a risk for that particular trade that you are willing to trade, and you are willing to take a risk of $100 for that particular trade, single trade. So by calculating the risk dollar amount, you can assign how much we are going to lose if the trade goes against us. Of course, if the trade happens, it's indicative. Of course, we are going to lose, and how much amount we are going to lose, which is $100 only. So in our particular this case, the maximum loss would be only $100 US. So risk planning will help you to control the mental part of the trading, because you already know that how much you are going to lose, and if the trade goes in your favor, then the reward is higher than your losing amount. Hope you get it now. So the trading risk reward ratio simply determines potential loss versus the potential profit, of course, on any given trade. So how to measure the risk reward ratio? Now you can check out here. The reward is simply defined as price distance between your entry and taking profit. Now this is the reward. In order to calculate the risk reward ratio, you need to have three components: your entry price, stop loss, and take profit. It means that where the entry level, okay, the stop loss means your risking amount or the percentage, okay, and this is your taking profit. So this percentage should be always higher than your risk value, risk of your trade. So here, at the conclusion of this particular risk reward ratio, let me explain. Let me take 2 minutes more from you on this one. That whenever we trade or that particular single trade, you are putting a risk of 2% or sometimes 5%, but your risk is rewarded and your take profit should be higher than this 5%. At least if you are going for 5% risk stop loss, then you must increase your target more than 70%. Especially if I give an example, 7 to 9% should be your earnings for that particular trade. So it means that if you lose $100 and if you're gaining, you should gain $130 to $150 for that particular trade. So hope that you understood about the risk reward ratio. Now let me move on to the position sizing. After taking position, what is position sizing? So should you always be buying 5 lots or 1 lot, or how many lots? You have no idea. So there are several ways you can determine how big that position should you be taking. So it's entirely under control to determine how big your position should be in order to be able to calculate our position sizing. So we need to know 3 things: actual account size, as per the investment, how much, what's the size of our account? So how much of that account want to be putting on the risk percentage? So we had examined this under the risk planning section just before. And stop. So the basic formula for calculating position size is like, sizing account size multiplied percentage of risk per trade. So that will be divided by your stop loss. Let's suppose, imagine that we have a fictional account size of $10,000 US. So we have a risk tolerance of 2%, of course, which we have just discussed before. And based on our analysis, we figured it out that we need 50 pips to stop loss. So this is our risk ratio. 50 pips and 2%. 2% comes like, to that particular trade, 50 pips of a stop loss. Now, applying to the above formula in the result to our position, size should be 4 mini lots. So it means that, let me just go some more brief in this particular section or area to make you more clear. Here, this chapter is going to explain you in this way that you have a good disciplined amount in your trading account, fine, and you are using only 2% of the risk ratio for your particular trade. So here it asks that you put a stop loss, strict stop loss, so that if the particular trade goes against to you, if this particular trade goes against to you, so it is going to stop your loss. Because for future, let's assume that if market falls, instead of 50 pips, if it falls 500 pips, then how much your loss will be? So to avoid that loss, it is asking, or it is recommending us to go for not more than 2% of the loss for this particular trade. So when we are going to apply this formula on each and every trade, of course, it is going to result as a position size. That it should be that we have to go for a mini lot, like 4 mini lots, 50 pips, or small amount of quantities. It might be any currency or any commodity. So the conclusion of this minimizing risk formula, like trading risk management strategy, you have having a trading risk management strategy, basically risking the entire trading capital and risk of getting a margin profit. You get me now? Like suppose if you are increasing the quantity, so there are the chances getting a margin profit. So smart trading also means that you need to have a trading risk to reward ratio 1:2, which just before I have explained that if you are putting a risk of $100, then you must expect 50%, 70% higher of your risk amount to survive in the long term. So this is also kind of a money management, which have proved many times to turn a losing strategy into a winning one. So to overcome the limitations of your trading strategy, you should focus on your trading risk management strategy. So we should read about on our trading strategies, which my session is going to be continued in the coming weeks, hopefully. So here we have an option called money management tips. So what are the tips you have to follow where the most of the professionals are following? because in this trading forex successfully requires a lot of features, of course, and proper education, which is the basic requirement, I should say. Quick adaptation towards the market updates and a number of other qualities as always to succeed into the trading. You will need a complete trading plan. So before you start any sort of trade, you require a complete trading plan. And a complete trading plan will tell you when to enter, when to exit, which currency pair to trade, and how to manage your money, which just before I have explained about the money management. So money management is also a vital important role which you have personally viewed just before, but it's only a part of complete picture. So the reason many traders lose money in the forex because their inexperience, which leads to the neglect of forex management principles. Just they go beyond their psychological effects, like emotions, I should say, well, psychological emotions. So they just carried away with the emotions and they start predicting by themselves with their inner feelings. So having other investment options on the side is also advisable, of course. The principle of money management in forex are quite easy to follow and have the potential to solve you a lot of losses if you adhere to the property. So the first step or the first quality of money management is quantify your risk capital. Meaning we have to find out, okay, and what would be the result of our risk capital. So calculating the risk involved in our trading process, if the chances of profit are lower in comparison to the profit to gain, stop trading first of all. You may want to use a trading calculator to measure the risk more effectively sometimes. Many of the important aspects of money management proceed from the key value. Example, the size of overall your risk capital will be a factor determining the upper limit of your position size. So you might consider it as prudent to risk no more than 2%, of course, of your overall risk capital in any one of the particular trade. Additionally, you can always implement risk management into your strategy to make sure you're managing the risk effectively. It means that just before I have explained, and we have gone through this one, that when you're going to take a risk reward ratio 2%, slightly sometimes negotiate from your end and add some more percentage. Instead of 2, you can go for 4% annual your risk reward ratio to convert your trade into profit. So move on to the next few more tips, and hope that you're getting me. And during this still, I request you that any point of time, you please your all questions and queries are welcome, and you can just forward your question in the chat. Of course, I'll be going to reply you the next moment. Fine. So let me continue the next point. So then, okay, avoid trading too aggressively. Trading too aggressively is perhaps the biggest mistake as most of the traders make. With a small sequence of losses would be enough to eradicate most of your risk capital. It suggests that each trade has too much risk. So a good way to aim for the correct level of risk is to adjust your position size, reflect into the volatility of the pair you're trading. But remember that more volatile currency demands a smaller position compared to a less volatile pair. Okay, so whenever you trade, be realistic. One of the reasons that new traders are overly aggressive because their expectations are not realistic. Because when the new trader enters in the market, they found one first or the second trade when it goes in their favor, they just try to trade as many as trade, and they just want to make the money or make their successful trades in the overtime. So usually it is not practicable, and it is, of course, it is not again recommended and advisable. So they may think that aggressive trading will help them to make a return on their investment very quickly, more quickly. However, the best traders may make steady returns. Setting realistic goals and maintaining the conservative approach is the right way to start. So admit when you are wrong, accept your mistake, and come out from the market. That do not re-enter at the same point of time or same moment. So the golden rule of the trading is to us, run your profits and cut your losses. Yeah, it is like run your profits. You have to run on your profits and cut your losses. It's essential to exit quickly when there's clear evidence that you have made a bad trade. Just before we were just talking on that one, on that particular thing, that when an aggressive trader or when you make any wrong trade, just accept the trade and come out from the trade. Then do not go retrading again that same moment, because of course it's a human tendency to try and turn on bad situation into good situation as much as fast, as much as quickly. But it's a mistake in the forex trading, no doubt, because we are the one who cannot control the market, financial market. Fine. So invest exit points before entering a position. Think about, and I always recommend to most of my clients, most of my investors, that you have to be always comprising, okay, and you have to be always on the compromising mode, that whatever the target you have made, okay, and the market is unable to reach that level, but it is almost reaching 90 to 80 to 90%, okay, change the target and compromise yourself to take the profit, come out there, because the market is going to give you another chance to the same day or the next trade, next trade sometime. But if you stick to the same target that and waiting the market should touch to your destination or your target, so it might not happen many times. So think about levels you are aiming on the upside and what levels of loss is sensible to withstand on the downside. So doing this will help you to maintain your discipline in that heat of the trade. So it will also encourage you to think in the terms of risk versus reward. So here we are just trying to focus on to book as many as smaller profits instead of one or short losses. Hope you get it in mind. Now we are about to finish this chapter, hopefully, that few special last important chapter. And these points are very useful in our daily trades, and I want you to just adopt these strategies when you make a live account. And of course, the best thing that you are going to adopt only when you make the live account, then only you are going to learn in the perfect way and the practical way. So let me move to our next tip and point, important point, using stop losses. Using stop losses on each and every trade position you initiate is a good money management, because stop loss orders shield your investment from unexpected shift in the market. Which just before I have explained that how much risk reward ratio we are putting. We are putting, let's suppose, 2%. It means if we are losing only 2%. Whether there might be any huge fall in the market, rest of the other traders might not have put any stop loss, so they will end with huge loss, or they need to hold the position for overnight. And next day you can carry forward your same investment with a new strategy and with a different position. I mean, switching the position on the other side is not long position or buy position, you can shift it to the short and short sell position. So there is a possibility always of a loss. Set up your stop loss order to exceed more than 2% for your trading balance. Any given trade. So let's say you have a trading balance of $20,000. Your stop loss should be about the 40 pips per trade. So, and that if the trade goes against you, all you lose is 40 pips or the $80. If even though the market falls further down and it might ended up with 200 to 300 pips, so you will be losing only 40 pips, which are $80. So the good money management strategy for it is based on survival, because until or unless you have equity, you are survived, the market is going to give you many more chances in the coming days. So this is the best thing, that it is a weapon. The equity what you have is your weapon, where you can fight with the market movements, market fluctuations every day, every time it has an opportunity and usage at that. Well, This can be mentioned using stop losses process only, the best and most efficient tool. And the next important tip is that don't trade on tilt. Tilt meaning at some point you may suffer a bad loss, okay, and you are going to have a substantial portion of your risk capital. So there is a temptation amongst us after being after getting a big loss and to try and to get your investment back with the next trade. But here's the problem: increasing your risk capital has been stressed. It means that at the moment we have met with few losses, okay, and our natural intention area arises, and it is trying to recover our losses at the next move. But it is, there are high probability and high chances are there that increasing of what you call the increasing of your risk and your capital, of course, it will be a kind of worst time to do. So instead of considering reducing the trading size to the losing speed, taking a break until you can identify a high trade. So always stay on even both emotional and in terms of the intuition side. It means that the market is going to give you more and more chances in the coming days and in the coming future. Right? So the last point is respect and understand the leverage. Fine. It means that whatever the discipline we have made before trading, but we have to follow and respect our own made discipline trading. Because leverage offers the opportunity to magnify profits made from the risk capital you have available, but it also increases the potential risk. It's a useful tool, but it is very important to understand the side of overall your exposure. So your broker may give you some leverage. Okay, you get to when you start any sort of trading, the broker might attract you by giving as much as leverage upon your investment to enable more and more bigger profits. But however, you have to be careful when using this sort of facility. For example, you are leveraging what is $200 or $400. It means that you can place a trade up to $80,000. On the other hand, applying leverage of 1 to 500 means you can trade up to $200,000 US. So here, the level of exposure to risk at this point of time is higher with a higher leverage. So at the time when you are a beginner, just try to avoid this high leverage and try to minimize your risk as much as to sustain in the market for a longer period and to grab and to avail as many as opportunities in the coming period, in the coming days. So when you have a clear understanding with the potential losses, therefore you will need not to suffer in the loss in the portfolio, and you can avoid being on the wrong side of the market. So hope you're getting me these tips which I have shared with you, which is your personal experience, including and the conclusion with me because of the session is about to end, and I really appreciate that you people have registered and your keen interest on forex investment, forex and commodity investment, etc. And you have to take this capital investment as your savings, because the investment is nothing but it's a gaining part, of course, but it is also a saving for your future. So the money what you have, what you're going to invest into the market, it is also a kind of savings which are going to give you in respectively returns in a period of time, not at the same current moment, but at a period of time. So like all aspects of trading, the best will vary according to the preference of individuals. So some traders are willing to tolerate more risk than others, because if you are a beginner trader, then no matter who you are. So the robust tip says is to start conservatively and experience personally to gain improved knowledge in the trading skills. So my personal advice and my personal recommendation and opinion to all the investors, all the traders, that before making any sort of trade, again you have to go back and make a plan, planning of trades, fine, and put a discipline while you trade, that how the trade should get started, what would be the my risk ratio, and what would be risk rewarding ratio. Of course, your risk rewarding ratio always higher than your risk ratio. Then only you are going to survive in this market. And the main and last important point I would like to just discuss with you and share with you, of course, that the rule, the discipline, whatever you make before you make any investment portfolio or any investment into the capital sector, capital area, you have to follow your own made rules. That is called the discipline. So when you are going to follow your own made rules into this capital sector of investment, then of course you are going to learn by yourself, especially, and you are going to share your experience to other investors, and you can improve your own knowledge with your previous skills. So hope guys, I really thank your appreciation and your participation with us, and I would like to give more information, on our company, which is Scale Investment, because we are licensed and regulated by CMA, Capital Market Authority of Kuwait, and here we provide a large number of currencies, commodities, and we always dedicated to the client service 24 hours, Monday to Friday. And here we provide as much as assistance to our traders, and we always work for the betterment of our investors, that how they can sustain in this market, in this investment area for longer period. And our services are always dedicated to the client section, where whenever the client feel uncomfortable, they are transferred to step back. But always we our traders with our investors and encouraging them to these sort of sessions. And we always welcome your reviews upon this session which we just completed. And I really thank you again, all of you, especially the technical team who worked with me. And this session has been completed successfully. Again, I welcome any sort of advisor, especially, and your recommendations. So, God bless you all, and happy trading, happy investment, and don't stop investing. Okay, right? So take care. Muhammad Ali is leaving at the moment, and any moment you can please feel free to ask any sort of queries, doubts, and send your queries to cs@lcminvestment.com. Take care then. Have a nice day. Goodbye.